How to get personal lines insurance license. Welcome to the quiz. If an insured's property is underinsured relative to its value at the time of loss, which clause may reduce the claim payment? Is it A, pro rata clause, or B, coinsurance clause, C, subrogation clause, or D, other insurance clause? The answer is B. The coinsurance clause in property insurance reduces the claim payment proportionally if the property is insured for less than a required percentage, usually 80% or 90% of its replacement cost at the time of loss, encouraging adequate coverage. Pro rata divides among multiple policies. Subrogation recovers from third parties. Other insurance coordinates multiple policies. Because coinsurance penalizes underinsurance, this clause reduces payment. Next question. How is collision coverage defined in a personal auto policy? Is it A, upset of the covered auto or its impact with another vehicle or object? Or B, any direct and accidental loss to the covered auto? C, loss caused by missiles, falling objects, or vandalism? Or D, theft of the entire vehicle or its parts? The answer is A. Collision coverage in a personal auto policy pays for damage to the insured vehicle from its upset, rollover, or collision with another vehicle or object regardless of fault. Any direct accidental loss describes comprehensive. Missiles, falling objects, or vandalism are comprehensive perils. Theft is also comprehensive. Because collision specifically covers impact or upset, this defines it clearly. Next question. An insurer uses an applicant's credit information to help determine premium. This practice is regulated by which law? Is it A, the Affordable Care Act? Or B, the Fair Credit Reporting Act, FCRA? C, the Securities and Exchange Act? Or D, the Gramm-Leach-Bliley Act? The answer is B. The Fair Credit Reporting Act, FCRA, regulates how consumer credit information can be obtained, used, and shared, including by insurers for credit-based insurance scoring, and requires notice if adverse action like higher premiums is taken based on credit. Affordable Care Act is health-related. Securities Act is investments. Gramm-Leach-Bliley governs financial privacy, but FCRA specifically covers credit reports. Because FCRA protects consumers in credit use for insurance, this regulates the practice. Next question. A named driver exclusion endorsement has what effect on the policy? Is it A, it provides additional coverage for a listed driver? Or B, it completely eliminates all coverage, liability, and physical damage when the excluded driver is operating the vehicle? C, it lowers the premium but still provides coverage if the excluded driver has an accident? Or D, it only excludes collision coverage for that driver? The answer is B. A named driver exclusion endorsement completely removes all coverage, liability, physical damage, medical payments, etc. under the policy when the specifically named excluded driver is operating the vehicle, even if permissive use would otherwise apply. This is used for high-risk drivers in the household. It does not add coverage. It eliminates coverage, not just lowers premium with residual protection. It excludes all, not just collision. Because it voids coverage entirely when the excluded person drives. This is its effect. Next question. For a loss to be covered under an insurance policy, the insured must have which of the following at the time of the loss? Is it A, a friendly relationship with the agent? Or B, an insurable interest? C, a claim form already filled out? Or D, a paid receipt for the next premium? The answer is B. Insurable interest is a basic requirement in insurance, meaning the insured must have a financial or legal interest in the property or life being insured so that they would suffer a financial loss if the event occurs. Without insurable interest, the policy is not enforceable. Relationship with the agent is irrelevant. A claim form is submitted after the loss. Premium payment affects coverage status, but insurable interest must exist at the time of loss. Because lack of insurable interest voids coverage. This is the essential requirement. Next question. Identify the primary purpose of the exclusions section within an insurance contract. Is it A, to broaden the coverage provided by the insuring agreement? Or B, to list specific perils, losses, or circumstances that are not covered? C, to define the duties of the insured following a loss? Or D, to specify the premium amount and payment schedule? The answer is B. The exclusions section in an insurance policy clearly lists the specific perils, situations, events, or types of losses that the policy does not cover, even if they might otherwise seem to fall under the insuring agreement. This limits the insurer's responsibility and keeps premiums affordable by removing high-risk or uninsurable items. It does not broaden coverage but narrows it. Duties after a loss are in the conditions or duties section. Premiums and payments are on the declarations page or in a separate premium section. Because exclusions specifically carve out what is not covered, this is their primary purpose in the contract. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.